So I just got done doing a video on how to calculate the value of a property if you're going to flip it, fix it up, resell it, or just buy it and resell it to a flipper himself and just get a quick return on your money. This is a great strategy. It's very simple and it's all about the number that you offer on the house. The cool thing with a rental is the price of the house is important. You know, lower you buy, the better off you'll be. But what also is very important is the terms of the financing that you get on buying the house. So you could pay maybe a little more for a rental if you can get a little bit better terms on your finance for the property. Because the ultimate goal of a rental property is to put passive income into your pocket. And I say passive because you got to manage your managers, right? So we're going to jump in this today. I'm really excited to share this with you guys. I'm going to try and keep this as simple as possible. A lot of people try and overcomplicate this and talk about, you know, your depreciation on it for tax purposes and make some very complicated formulas. And I'm going to keep this as simple as possible to where it makes a lot of sense, and this is something that you can do with your personal money and build a portfolio of rentals that can provide you financial freedom and retirement from your day-to-day job. So here we go. Let's jump into it. So first is you need to figure out what your rent income is going to be on a property. So it doesn't matter if this is a 50-unit apartment complex or if this is just a small condo that you have. So once you figure out what the rent is going to be, and if it's something that you're going to be buying, be careful that you don't look at what the projections of what the rent could be from the seller. Look at what the actual current rent for that property is. Because if they could get more easily, they would get more. Maybe with a little bit of a remodel, you could increase rents, and that's something that you could talk to a property manager about and get a professional in your area that can really help you calculate what the rent income is or what the potential rent income is, okay? The next part of the formula is subtracting the expenses out of the rent. So what I would do is I would calculate what your total income is for the year as far as rents and what your average expenses are going to be throughout a 12-month period. Apologize, I need to turn my phone on silent. Let's keep going. So next is figuring out all of the expenses. So many people think the financing of a rental property is considered part of your expenses. And it is in the formula, but do not calculate it in your expenses yet. Your expenses are going to include your HOA fees if you have an HOA. It's going to include your vacancies. It's going to include your repairs and maintenance. But before I move on from vacancies, keep in mind that let's say you have a property and on average it goes vacant of every 2 years for maybe a month or 2 months, but that's a lot of money. Let's say it's $1,000 in rent income. Now you have 1 month or 2 months every other year that you're not going to have any money coming in. So you got to make sure you calculate what that expected vacancy is going to cost you. So let's say it's $1,000. It's 2 months out of 2 years. That's $1,000 a year. So you put a $1,000 expense per year for vacancies. You got to make sure that that's calculated because that's going to be really painful if you're having to take money from another business you have or your job. Even worse, that you're spending time to get that money and you're having to put it into a rental so you don't go under because you can't pay all of the expenses, right? You want that property to make you money, not cost you money, okay? So calculate vacancies, the repairs and maintenance, right? General maintenance, general repairs that are going to happen. You know, things like roofs go bad, siding needs to be repainted, toilets need to be unclogged. There's always going to be maintenance, and what you can do is you can calculate what those general expected repairs are, or even better, if you're buying it from someone, you can ask them for the financials on that property, all of the repairs that were allocated to that property. Also, keep in mind, if you're buying a property that has deferred maintenance, you can calculate what they have spent and increase that by a substantial amount to make sure that the maintenance is taken care of correctly, okay? Next is a property manager. So many people want to get into real estate investing and they think, oh, I'll do all the repairs myself, or I'll do all the property management myself. It's not hard to do. And I think that is not a very smart idea, because many of you, if you're listening to this and you're looking to get into real estate investing, I would highly suggest letting the professionals do what they do well. For example, I don't mow my lawn, not because it's a job that doesn't make sense for me to do. It's because I get paid more money to do other jobs. I'm not going to go get a job this next summer mowing lawns because I would only make $15 to $20 per hour. So why would I go get a job at $15, $20 an hour when I can be making thousands of dollars an hour or hundreds of dollars an hour with another business opportunity? And so it's the same thing with this. If you're looking to start a property management company, that's a wonderful thing to manage your own properties as well. Or if you have a handyman company, then yes, maintenance and repairs may be a fit for you. But I would highly suggest that you calculate all these expenses so that this business of holding rentals serves you and not takes you away from your family and does not take away from your freedom. That it puts money in your pocket and liberates you for time as well. So calculate property management fees. Property management fees, a lot of times they have a setup fee. They'll have a percentage of what the rent incomes are. The more rentals you have, the better rates they're going to give you. They're going to give you anywhere between, I've seen as low as 4% of the rents up to 10% of the rents as far as an expense. Next, you're going to have taxes and insurance. If you get a traditional mortgage or if you get a mortgage from a mortgage company, most of the time that's going to be paid as you pay the mortgage, but calculate that as well, okay? That's going to be your expenses. So it's rent minus expenses, and then that's going to equal your NOI, or your net operating income. So you're going to have, let's say, $1,000 in rent minus your expenses. That's going to leave you with maybe what, $400 to $300 a month, right? Depending on where you're at. Now you have to figure out, can you afford to pay the financing on the property? If you're buying the property cash and there's no mortgage, then yes, you're great. But a lot of times we want to be able to leverage someone else's money, whether it's the bank's money, a private investor, or even the seller's money. So sometimes if you're doing what I do, which is are in the business of sourcing your own deals, you can find properties that someone wants to sell, but they're okay to sell where they are the bank. So this is where it gets so important to understand that price isn't the number one leading factor in what you can pay for a rental property. But it's also very important to understand that the rate, how long the mortgage is for and for what interest rate. So if you got a 0% interest rate, let's say your net operating income, so rent minus expenses, is $400 a month, but your financing costs you $405 a month, you're going to be losing $5 every single month, and that's not really a good strategy. You want to make sure at the end of the month, every month, is you're putting money in your pocket with your rental. So, but if, let's imagine that you're only going to make $1 profit every single month, but you have 0% interest, you get a seller finance deal where all $400 of that rent that you're paying towards a mortgage is going towards paying down what you owe on the property. That's a great way to offer your seller a lot more money, but be able to make good money on that investment, because you're going to be paying down what you owe him every single month and there's no interest. So there's a good return on your money by doing it that way. So your net operating income minus your financial payments, whatever's left over is going to be your cash flow. So if you put this into your calculator and you're going to lose money every month, you're going to have a negative cash flow. That is what you want to 100% avoid. You want to go for a positive cash flow. I know that's very simple, but so many people think, well, it's okay because in 20, 30 years, I'll be able to retire off of all these properties. But that's where you get into a huge problem, because let's say you lose your job or you lose your business or wherever you're sourcing your money to pay for these rentals. That's when people go under and lose their credit and lose everything they've worked so hard to do because they can't afford to make those payments. So be careful as you're picking up these properties that debt can be a burden, and to make sure you buy properties with the right price and the right financing to make sure that those tenants are paying the mortgage and not you. So that's how I would calculate and look at every single rental that I would acquire. I bought tons of properties. I bought properties through seller finance, through subject to, with cash, with traditional financing. It's quite fun. I actually bought my very first property I ever bought with my wife. We bought it right after the market crash of 2008. I got a fantastic deal. I bought it for $60,000. It was actually $55,000 because I got a $5,000 grant because I was a first-time home buyer. We lived in half and rented the other half. My total rents between the two sides once we moved out of there was about $1,400 a month. My monthly expenses and everything else was only about $400 or $500. And then on top of that, my mortgage was only about $450. So I had a very good positive cash flow for years. I've been paying down that mortgage. I only owe about $50,000 on that property. And what I've been able to do is list that property actually 2 days ago, and I have listed it now for $240,000. So after I pay my listing agent and everything else, we're going to make somewhere around $150,000 profit is what we're hoping to do, or more. So we're very, very excited about that, and we did that because we bought at the right time, and we've been able to cash flow for all that time, and now we're going to sell it now that the market's inflated, and be prepared for when more rental opportunities are available. But there is rental properties around us every single day. That is the business that I'm in. I'm continually sourcing these deals. That's what I actually teach people. That's why I'm talking to you today, is because I focus on helping others find deeply discounted properties in your own market. I have a live webinar where I talk about all of the strategies that investors use to find these properties, and my favorite strategy, which I call driving for dollars. You can check out my live webinar at dfdmastery.com. You can check us out there. You can also follow me on other social media platforms. There'll be a link to all this in the description of this video. So thanks for tuning in. If you have any other questions, if I can help you in any of your real estate needs, please comment. I love the engagement and I love to help people. So thank you so much for tuning in. We'll talk to you guys soon.